Alrighty. So today's topic is on profiting from overreaction and volatility spikes. Alright, so if you have been monitoring the market situation in the past week or so, then you will know that there has been this fiasco going on with the banks in America again, but basically it's just the Silicon Valley Bank and the smaller banks. So there has been a lot of this fiasco going on, and the market has made very big moves, a lot of overreaction as well as there are volatility spikes. So these are the times where you can actually have some opportunities to sell premium, because as we know, when the volatility really spikes, then the premium is going to be pretty juicy. So this is where, as premium sellers, we do want to take advantage of this. So I'll be sharing with you, how you can identify such opportunities, as well as share with you a trade which I did as well. So the trade which I did is on the iShares Russell 2000 ETF. The ticker symbol is IWM. So basically this holds the 2000 small cap stocks, or rather the bottom 2000 small cap stocks. So in this IWM, there are some financial stocks. So of all the index ETFs, right, the spiders, diamonds, QQQs, and this IWM is the one that was hit the most, in a sense whereby there is a very big move in the index ETFs, right? So as you can see, the market really sold off down here. So it was a pretty big move. You can see there's a gap down as well, and there were days that were down like 2-3%. Okay, so during this time you can see that the VIX have really spiked all the way up to almost as high as 31, and it started off somewhere around 20s, right, even below 20s. So you can see that this candlesticks, you can see the moves are all really very big. So it's a very big spike from where it started off, and this all happened in just a matter of few days. So this is a time, as premium sellers, we really want to take advantage of this, right? When the premium is high, it's very juicy, so that we can have pretty quick profits when the volatility eventually contracts back down again. Because one of the things we know of the characteristics of volatility is that it is mean reverting, right? So there will be spikes up, and then it will come back down again. And then as you can see, when the market is kind of the VIX volatility is going nowhere, sideways, it will be time where it will spike back up again, and then after that it will come back down again. So this is the characteristic of the volatility. It's mean reverting, as we already know. So that is why when the market presents us such opportunities, usually when the market really tanks, really crashes, or all this kind of news, then this is where you can have this huge spike in the VIX, and then you can put on some trades, right? So the trade which I put on is a short put, right? So when the market really sold off, I think somewhere around this point down here, roughly around 171 or so, this is when I decided to put on a short put. So I put on the 164 short put, which is roughly around 25 deltas when I put it on, and I got it for $4.51, and that is about $450 or so. So you can see, when I put on this trade, it was pretty close to the previous low. So this is where, usually there's some sort of support. So it's a good time for me to get into a bullish strategy. And as you can see, just very quickly in the next few days, right, it's almost 50% in terms of the profit, right? I sold it for 4.51, and then the mark was somewhere around $2.44, almost 50% profit, and somewhere actually during the day it was around 50% profit, right? So if you wanted to take off your profit at 50%, you could have already done so, and this is just in a matter of days. When I first put on this, there was around 45 days, right? There's around 45 days left to expiration, so this is just about 3 days or so, and very quickly you can see when the volatility drops, right? So in the next few days, most likely it's in this candle bar down here. When the volatility drop, immediately there's a huge profit, right? I put this on when the VIX was somewhere around 30, so I got in somewhere around the high of the VIX. And then when the market gaps up, you can see there's a gap up the next day. This is when the volatility dropped, right? So this is where you can see that there's a pretty big profit in terms of the short put, because the short put, as we know, has three things going for us, right? We have the positive delta. That means to say that when the market goes up, this short put will be in profit, all right? The higher it goes, then the more of this premium it will lose more of this premium, and that's where the profit comes from. And then we have positive theta. So positive theta just means that over time the value will start to decay as well. So we have this going for us as well, and then we have negative vega, which basically is a profit from a crush in the volatility. So when the volatility starts to go back down, this is where you have a profit on your short put as well, right? Basically the value of the short put will start to drop pretty quickly when there's a drop in volatility. So you can see that there are three things going for me simultaneously when the market gapped up, right? So when the market gapped up, basically it went up, so I have made in terms of positive delta, and then days have passed, although not many days have passed, right? But over time, we know that over time this positive theta will be working in your favor, so you're collecting a little bit of profit every single day as long as you're holding on to this trade. And then you have negative vega, right? Negative vega when the market, or rather the volatility starts to drop. So the delta and the vega kind of works hand in hand, right? Because when the market goes up, then the volatility will drop, right? So this two kind of works in tandem. So obviously, the next few days, the market, right, closed on Friday. It was somewhere around 171, somewhere around the place where I first entered, but then the volatility is not as high, right? The volatility, you can see, has dropped from its highs of around 30 plus, 31 or almost 30. So although the price is somewhere around the same price when I first put it on, the position is still in a profit, right? It's still in a profit. So you can see this is where you can really profit from such overreactions. So the next question you might be asking is, where do you actually place the trades? Because this fiasco, this whole banking thing has been, it has taken place over a number of days. So how do you know where to put it on? Well, the first thing is, if you know how to read charts, or you know how to use technical indicators, you know how to read support and resistance, then you probably would have an idea where you want to put it, right? So somewhere around here, near the support area. But what if you're someone who don't know how to read charts, or you're relatively new to trading the markets, or even just trading options? Then a simple way where you can identify opportunities in the market is by placing what I call the income grid. So you can see the income grid basically just by drawing levels, right? You have many different price levels. So all these price levels gives you an opportunity to place on certain trades. So in this sense, this is vertical diversification, right? So you have two types of diversification. You have horizontal diversification. So horizontal diversification is basically where you enter trades into different stocks. So let's say, for example, you have stock A, stock B, and then stock C. Then you enter a trade in stock A, and then maybe you enter in stock B again, and then you enter into stock C. So this way you have three different stocks, and you would be somewhat diversified. But the problem with this diversification is that when the market crashes, everything will start to go down, right? Stock A will go down, stock B will go down, stock C will go down. And when you enter it, you roughly entered around the same price. Because let's say, for example, when the index ETF is somewhere around this point down here. So you look to stock A, so maybe you enter into Google, then you enter into a bullish strategy in A, and then you go to B, maybe this would be in, let's say, Microsoft. Then you enter a bullish trade down here. So in stock C, maybe you enter a bullish trade also in P&G. But then when the market crashes, all equities tend to have pretty high correlation then, right? Because you can see in 2020 pandemic, even in 2022, when the market crashes, they all tend to move at the same time. So when you enter the stocks at around roughly the same timing, then guess what? When the market crashes, all your positions will be caught. That is why I received quite a number of emails, people asking me, say that, what should they do now? Because their stocks, they enter roughly towards the end of 2021. So any stocks that you enter roughly around 2021, you will be caught, because the market started to sell off in the beginning of 2022. So that's where the problem comes with horizontal diversification. Now, the other form of diversification is vertical diversification. That means you can actually go on to just a single stock, or in this case, a single index ETF, which it comprises of many different stocks. And then instead of going to other different stocks, you stick to just one product or maybe just a handful of products, and then you enter different strategies down here. So in this case, let's say for example, if the price goes down to 190, then you can say, all right, I want to enter a strategy down here, either bullish, bearish, or neutral. Then if the market goes to 185, you enter another strategy again, and so on and so forth, right? So as the market goes down, right, you have different strategies. So this way you're really diversified in terms of different price levels. So even though if the market goes down, you may, let's say, lose money on 190 if it's a bullish strategy, but if you have a bullish strategy on 175, then guess what? Then this chances is that if the market was to recover, then you would profit on this. So this way you are diversified in terms of the different price levels. So this is what you call vertical diversification. So you have different strategies on different price levels. At the same time, you have on different expiration dates as well. So this really smoothens out your P&L volatility compared to if you were to do horizontal diversification. So by the way, if you were to enter into Google for stock A, and then Microsoft for stock B, and then let's say you enter into Apple for stock C, guess what? This really isn't any diversification because you are all into tech stocks, right? So if the tech stocks in the sector was to crash, all of them would be hit. So you want to diversify in terms of different types of sectors. Maybe you have the healthcare sector, then you have the technology sector, then you have the consumer staples sector. So this way, at least the crash, when the crash comes, it won't be so bad, right? A better horizontal diversification would be in different product assets. Let's say maybe in golds, silver, maybe in oil. So this way, when the market crashes, the correlation won't be that high, right? But my preferred approach would be vertical diversification because I don't really like to trade in so many different stocks at one time, right? Some people have asked me, how do you search for the different stocks to enter? Well, the thing is, I don't really do that, right? I just have a watch list, a handful of watch lists, about 10 stocks or so, comprising mostly of index ETFs, and then I just look at them. Right, I don't keep looking for the new stocks or the new hotter stocks that's in play. So this way, every day I just look at them, and then I look at my income grid. I look at the price levels. So when you look at these price levels, this income grid, it presents you with 4 different choices, right? At each of these levels, you have an opportunity to do one of 4 things, right? The first is that you can place a bullish strategy, right? Bullish strategy, maybe you want to place a short put or maybe a bull put spread, bull call spread. Any of this bullish strategy you can put on, right? The next choice you have would be a bearish strategy, right? Bearish strategy, maybe you have a bear call spread or maybe a debit put spread like the bear put spread. And then you have the neutral strategy. So let's say maybe you think that the market might be going sideways, then you might want to put on an iron condor, maybe a butterfly, or even a strangle if your capital allows. You have a bigger size trading account. And last but not least, you have obviously the choice to do nothing as well, right? There's no need for you to force a trade if you don't see an opportunity there or you don't have any view or bias on the underlying stock, right? So for example, in this case, let's say the market first trade off to 195. So at 195, you can see that the market has been extended. The first time it goes to 195. So you might say to yourself, I'm pretty bearish on this. So I might want to place a bearish strategy down here. So if you place a bearish strategy down here, maybe you say that, all right, I want to place a bear call strategy. So you might place a bear call, right? Bear call is basically you sell one call option, fire out the money, and then further out, you buy back another call option. So this way you have a bear call strategy on 195. So when the market starts to go down, all right, it comes to 190, then you might say, oh, I'm still bearish on this. Then you could enter another bear call spread. Or maybe this time you might be saying, I'm somewhat neutral. Maybe it looks like it's going to go sideways. I think it may go sideways from here. Then I'm going to place a neutral strategy, right? So you can see you have a variety of different strategies that you can place on as the market moves. So if the market comes down here again, you might say that, all right, at 185, maybe I'm neutral again. I place another neutral strategy. And then when there's this huge move down, and then there's a spike in volatility, you might say, all right, maybe this is time I'm feeling a little bit bullish. I'm thinking that there's going to be a step back in terms of the price. Then guess what? I'm going to place a bullish strategy down here. And as the market goes down, the volatility is still high, then I may want to place another bullish strategy again. Then when the market recovers back up, and you might be having a position on still, right? Because maybe only a few days have passed since you placed this, then this is the time where you can basically do nothing, right? There's no need for you to force a trade if you already have a trade on for this level. So basically all you're doing is you're diversifying in terms of different price levels, different strategies, and you also have different maturity dates, different days to expiration for each of this strategy. So in this way, you really have a very diversified kind of options portfolio, rather than, you know, you put on A, B, and C, same kind of strategy, and then they all crash at the same time because you all roughly have at around the same price level. So in this way, you are going to have a much more smoother P&L volatility. That means you will notice that on certain trades you will lose, certain trades you will make, because you are all at different price levels and different maturity dates. So if the price, let's say for example, from 175, it goes up to 185. Right? If it goes to 185 at this point, all right, let me just remove all the drawings to make it very clear. So let's say at 185, so what will happen is this, right? Maybe you will lose money on the 190, let's say if you have a bullish trade on, but then if you have a bullish trade on 180 and 175, then you're going to be in profit. And then for this 185, you're going to have a neutral strategy. Then guess what? It's going to be profitable as well when the market comes back to this point. Or let's say, for example, the market does trade lower. So in this case, maybe you have a neutral strategy here, and then your bullish strategy, you have this on down here, you have this on down here, you have, right, as it goes down, you place maybe another bullish strategy, and then the market comes back down here. Then maybe you might lose on this, you might have a slight profit on this neutral strategy or bullish strategy here. You have definitely a profit here, you have a profit here. So you can see it kind of really smoothen things out compared to if you were to place all your trade, you know, at just one level. Down here, let's say you think that it's going to go up, so you place a bullish trade, and then all you can do is just hold as the market goes down. Right? So when you have this income grid in place, it really presents you a lot of opportunities. So this really beats having to read the chart, right? Some people like to do all this chart pattern analysis where they see maybe a flag or head and shoulders pattern, or maybe analysis into the candlestick patterns, right? You do not have to learn all this when it comes to options, because options is all a probability game. Unlike outright trading, you know, when you just buy or sell when the price hits your limit order, with options you already know your probabilities up front. You already know what are your chances of winning on the trade, and all you have to do as premium sellers, we know that implied volatility always is greater, right? Most of the time implied volatility is greater than the realized volatility. So that's why it favors us option premium sellers, whereby when the probability states that, let's say for example, you have a 70% chance of being in profit, then because the IV is always more than the realized volatility, most of the time in the long term, your win rate is going to be slightly higher. So all you have to do is just let your probabilities play out, and then it's perfectly fine to just trade, you know, one or two products. In fact, I know of a number of people who just trade mainly the spiders or maybe the SPX, and then all they do is just diversify in terms of strategies, price levels, and the expiration date, and that's more than enough for you to have a very good result in the long term. Alright guys, that's it for this video, and I hope you found this video helpful. And if you like this video, please give me a thumbs up and also subscribe to my channel as well. This way I can create more videos like this for you. And last but not least, thank you for watching. I appreciate your time, and may the options favor you.